Hello everyone and welcome to Financial Accounting. In this chapter we're going to be going over liabilities, and the main focus would be on current liabilities, installment notes, and contingencies. Another important part of this chapter is payroll, so we're going to be going over the payroll expenses and all the different elements of payroll. So first let's start with current liabilities. So as it says here, when a company or a bank advances credit, it's making a loan. The company or bank is called a creditor, or in other words, this is what we call the lender. The individuals or the companies receiving the loans are called the debtors, or the borrowers. And by the way, the creditor and debtor here, I know they sound like debit and credit, but they have totally different meaning. So don't try to link creditors and debtors to debit and credit. So debt is recorded as a liability by the debtor. So long-term liabilities are debts due beyond 1 year, and current liabilities, these are debts that will be paid out of current assets and are due within 1 year. So as we know in long-term assets or property, plant and equipment or fixed assets versus current assets, the cutoff line is 1 year. Same thing for long-term liabilities and current liabilities. If we have a debt that's longer than 1 year, it's considered to be long-term liabilities. If it's less than 1 year, then it's a current liability. One of the good examples of current liabilities is accounts payable. So we're going to be talking about accounts payable and accruals. And I want you to remember, accruals are any kind of unpaid liabilities. So if we have an expense that we incurred but we haven't paid, then this is what we mean accruals. So accruals, in other words, it's the unpaid expenses. So accounts payable transactions involve a variety of purchases on account, including the purchase of merchandise and supplies. Accrued liabilities reflect an obligation to pay current assets in the future. Again, remember, accrued liabilities is the same as accrued expenses. So these are expenses that we incurred, but we haven't paid yet. So they reflect an obligation to pay current assets in the future. Accrued liabilities are normally recorded at the end of an accounting period as part of the adjusting process. And as you remember from chapter 3, this is where we have the adjusting entries. Accrued liabilities was one of the important factors that lead to adjusting entries that we do at the end of the period. So for most companies, accounts payable are accrued liabilities, and accrued liabilities are the largest portion of current liabilities. And you'll see like the biggest part of current liabilities would be accounts payable. So now let's talk about short-term notes payable. These are notes that have to be paid in a period less than 1 year. So notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an accountant or an account payable created earlier. So let's see an example. And this is again an example for an accounts payable that was created, and then we're converting it into a note payable. So assume that Nature Sunshine Company issued a 90-day 12% note for $1,000 dated August 1st to Moray Company for $1,000 overdue account. So they have an overdue account of an account payable, and instead they are signing a note for 90 days 12%. The journal entry to record that would be as follows. We want to get rid of the accounts payable, and remember, accounts payable, they have a credit nature. They're normally on the credit. When we want to cancel them, we are going to debit them. So somebody might ask me why we're canceling them, because we are replacing it with another form of note, which is the notes payable. So we're going to debit accounts payable to cancel it for Moray Company, and then we're issuing a new note, which is a promise that we're going to pay Moray Company in the future. So note payable here is $1,000, and it's for 90 days, 12%. So this is exactly what we do whenever we are converting an accounts payable into a note payable. The note payable here is still considered to be current because it's for a period less than 90 days. If it's longer than a year, then it would be classified as a long-term liability. So when the note matures, the entry to record the payment of the $1,000 plus the interest would be as follows. And remember how we calculate the interest. It's the principal, which is $1,000, multiplied by the rate, which is the 12%, multiplied by the time, which is 90 days, divided by 360 days of the year. Again, we just assume 360 days to just make the numbers easier for us to deal with. In real life, these kind of calculations are basically done with a perfect days for the year, which is 365. So in this case here, we are going to cancel the note, and we're going to debit the note payable for the $1,000. We already calculated the interest expense, which is 1,000 multiplied by 12% multiplied by 90 divided by 360, and it turned out to be $30. So the interest expense is also debited. So we're going to debit $30 for interest expense. And then the amount of cash that we have to pay is the $1,030, which is the total for the note plus its interest. So the interest expense is reported in the other expense section of the income statement. Of course, interest expense, they belong to the income statement. They're not part of the balance sheet. But where on the income statement, it belonged to the other expense section. The interest expense account is closed at December 31st. And again, this is just something that we all know, that at the end of the year, all these temporary accounts should be closed. And one of those temporary accounts is interest expense, or in other words, all the expense accounts, all the revenue accounts, they have to be closed at the end of the year. So each note transaction affects a debtor, who is a borrower, and the creditor, which is a lender. So we're going to see like a side-by-side comparison for how the transaction would look on the borrower side and then the lender side. So here we have two companies. We have Bowden Company and Coker Company. Bowden is the borrower, and it starts with a letter B for borrower, and Coker is the creditor, or in other words, the lender. And we have Coker here with a C like the creditor. So let's see the first transaction. It says here on May 1st, Bowden Company purchased merchandise on account from Coker Company, $10,000, $210 net 30. The merchandise cost Coker $7,500. So let's start with the borrower's side, because that's our main focus here on this in this chapter, which is to see how the liabilities are going to be recorded. So we purchased inventory on account. So we're going to debit inventory, which is the asset we acquired. So it's going to be debited, the asset, for $10,000. And we're going to increase our liabilities, which is the accounts payable, for $10,000. Remember from previous chapters that whenever we are the sellers, we think about two transactions, one for the sales and one for the cost of goods sold. The sales transaction would be based on the $10,000, which is the selling price, and the cost of goods sold transaction would be based on the $7,500. So let's start with the sales transaction. Again, we're making sales. Sales is a revenue, so it goes on the credit side, and we debit accounts receivable, which is a promise to get the cash from the borrower, or in other words, in this case, the customer or the client who bought these products. So you can see this is just the image of the other journal entry. So for the borrower, they credit the accounts payable. For the creditor, they debit the accounts receivable. So we debit accounts receivable, credit sales for the same value. The additional journal entry is for the calculation of the cost of goods sold. Of course, that's not recorded on the borrower's side. Why? Because the borrower doesn't have any kind of cost of goods sold here. So this is the journal entry that we've traditionally been recording whenever we make a sales under the perpetual system. So we debit cost of goods sold, and we credit merchandise inventory based on the cost value, which is $7,500. On May 31st, Bowden Company issued a 60-day 12% note for $10,000 to Coker Company on account. So in this transaction here, you see that the $10,000 accounts payable, they couldn't pay, so they asked for like more time, like 60 days. And instead of having just accounts payable, it's going to be in the form of a note. So we're going to sign a note promising Coker that we're going to pay them within 60 days plus 12% interest. So we're going to debit accounts payable because we're canceling the accounts payable, and to replace that, we're going to credit the notes payable for $10,000. The same idea would happen to the creditor. They're going to cancel the accounts receivable by crediting the accounts receivable, and instead they're going to debit that new asset, which is the note receivable, for the same value, $10,000. 60 days from May 31st, they are making their payment for the note plus the interest. So Bowden Company paid Coker Company the amount due on the note of May 31st. How we calculate the interest? Again, it's the principal, $10,000, the interest, which is 12%, and the rate, and the time, which is 60 days divided by 360. and it turned out to be $200. So we're going to debit the notes payable to cancel the note since it's going to be paid, $10,000. We record the interest expense for $200, and then we credit the cash because we're paying cash for $10,200. This cash that is paid by the borrower is going to be collected by the creditor at the time of maturity, which is the 60 days. So we're going to debit cash for $10,200, same cash, because whatever is paid by Bowden is received by Coker. And then we are going to earn the revenue, record the revenue earned, which is interest revenue for $200 on the credit side, and then we cancel the notes receivable on the credit side for $10,000. So I think it's a good comparison to see the borrower and the creditor side by side and see how things look from different perspectives. I think it's very logical, it's very easy to understand. The only thing that students tend to forget is this cost of goods sold journal entry. If the company, if the Coker company was one of those companies using the periodic system, this journal entry would not be recorded, and that would be the only difference here. So a company may also borrow from a bank by issuing a note. So instead of just buying products, sometimes we can borrow some cash from the bank and then we sign a note instead. So let's see this example. Assume that on September 19th, Iceberg Company borrowed cash from First National Bank by issuing a $4,000 90-day 15% note to the bank. The entry to record the issuance of the note and the cash proceed is as follows. So what are we going to do? We're going to debit cash for $4,000 and we're going to credit notes payable for $4,000. Why we're doing this? We are the borrower, we're not the bank here. So we're recording on September 19th that we received cash, and cash is on the debit side, and we also created a new liability because we signed a note, and this is going to be recorded on the credit side. On the due date of the note, which is December 18th, Iceberg Company owes First Bank the $4,000 plus the interest. Remember, the interest was for 90 days, 15%. So we take the principal, 4,000, multiply by 15%, multiply by 90 over 360. 15% is the interest rate, 90 over 360 is the period. And again, it's a short period because it's less than 1 year. So it's current liability. So the journal entry would be very similar to what we've seen before. We're going to get rid of the note because we're already going to pay it. So we're going to debit notes payable for 4,000. The interest expense incurred would be $150, which is based on the previous calculation we just mentioned. And then we are going to credit cash for the total of the 4,000 plus the 150, which is 4,150. In some cases, a discounted note may be issued rather than an interest-bearing note. And sometimes we refer to it as a non-interest-bearing note. It's a note where it's discounted, or the interest is discounted. So let's try to understand how this works, and we'll see an example also. So in this case, the interest on the note is called a discount rate instead of just interest rate. The amount of interest on the note, called the discount, is computed by multiplying the discount rate times the face amount of the note. The debtor, or in other words, the borrower, received the face amount of the note less the discount. And we call that the proceed. So in simple words, we sign a note for $1,000, but I don't receive $1,000. I only receive $900. But at the date of maturity, I'm going to pay the $1,000. So somebody might ask why I'm signing a note for $1,000 and I'm only getting $900 is because there's interest implied in this transaction. So we don't really mention the interest rate on the note itself. We just say that you're going to pay me this amount of $1,000. But the amount that you receive, which is the proceed, is going to be a discounted amount. So the debtor must repay the face amount of the note on the due date. So let's see an example. So it's slightly different. The idea is the same. Like in the regular or the interest-bearing note, we borrow $1,000, we pay the $1,000 plus the interest. And in our previous case here, like it was $200. In this case, it's different. I'm going to borrow, let's say $800, $900, but I have to pay it as $1,000. And the note says that I have to pay $1,000. So let's see this example. Assume that on August 10th, Carey Company issues a $20,000 90-day discounted note to Western National Bank. the discount rate is 15% and the amount of the discount is $750. So we take the $20,000 multiplied by 15%, multiplied by 90 divided by 360, and that's how we got the $750. Remember, the 15% now is a discount rate. So in this case, the proceed is going to be equal to the $20,000 minus the $750, which is the $19,250. So as a borrower, I'm here the debtor, I'm receiving cash of $19,250. And I owe the creditor $20,000. And then the $750 is the amount of interest expense I'm going to incur. So I'm going to record interest expense as $750 and credit notes payable for $20,000. At the time of payment, the journal entry would look like that, which is November 8th, which is the date this note is going to mature. I'm going to debit the note payable to cancel it and pay the cash, which is the $20,000. So I'll just go back one slide. See, I borrowed $19,250 and I paid back $20,000. It's the same idea. We borrowed less to pay more in the future, and that's because of interest. But in this case, the interest is implied in the face value of the note. One more thing, which is something called the current portion of long-term debt. If we have a debt that is, let's say it's a mortgage for 15 years, and we pay a regular kind of mortgage payments. These payments are going to be paid on a monthly basis for the coming 15 years. The current period of that long-term mortgage is going to be considered a current portion of long-term debt, because remember, during the current year we have to make like 11 or 12 payments for that part of long-term note. This current portion is going to be considered a current liability. So the current portion of long-term debt, such as the current portion of installment notes, are reported on the balance sheet as a current liability. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. Installment notes are often used to purchase property, plant, and equipment. And this is why we always think of mortgages, because like buying a building or a house or a warehouse or something like that, that would be considered to be a part of the property, plant, and equipment. In many cases, it's bought through a mortgage where you have installment notes. So let me stop here. In the next video, I'm going to be going over payroll liabilities.